Hello everyone, we are Group 4 and our group project for this week is the Royal Philips case study with the theme of sustainable finance. In this presentation, we are going to assign a value for Philips, taken into consideration ESG factors. So first off, a little bit about Philips and its value creation. Philips is a health and medical technology company and which based in the Netherlands, and it operates in three segments: diagnosis and treatment, health informatics, and personal health. So since 2017, Philips has shifted its focus from building machines to providing solutions for healthcare professionals and patients. It has been a leader in sustainability efforts, and it has been integrating the ESG factors into its financial performance and financial statement. For the competitive position, Philips has many advantages, and one of that is the technological innovation, data science, and the effort in sustainability. Philips has been a leader in many markets within the healthcare industry, and over 60% of sales of Philips comes from its market leadership position. 70% of sales come from green solutions. So for the value creation, there are two factors that contributes to the value creation of Philips, which is the innovation in healthcare solutions and Philips being the pioneer in analyzing big data to target market segments more accurately. The company also has 5 pillars: intellectual, manufacturing, HR, natural, and social, and all contributes to the financial metrics of the company. So in order to assign a value for the company, we first have to look at the cost of capital calculation. So the data we obtained was from the case. The data was in 2017, and the forecast was from 2018 onwards. So in the case, they have calculated the cost of capital, but our group sees that it is not reasonable because of the two reasons. The first is that the case assumes that Philips has no debt, so the cost of capital is also the cost of equity. And the second is that the case used the intuitive or weighted average method to reconcile the WACC when the risk-free rate assumptions are different. They assign 3/4 of the weight to 4% of risk-free rate and 1/4 of the weight to 1% risk-free rate. So we decided to recalculate the WACC using what we have learned at Rotman. First, we determine the targeted debt over equity ratio by averaging the number of 3 years, 18, 19, and 20, and we arrive at the ratio of 36%. Then we use the given leverage beta to calculate the cost of equity. We took the leverage beta as given because we have no information about other comparable firms. So with that, we arrive at the cost of equity of 8.84%. And to calculate the cost of debt, we taken into account the risk-free rate and the credit spread. So on Philips' website, the credit rating of Philips is A- according to Moody, and it is equals to 1.22%. So after having the cost of equity and cost of debt, we then use the formula to compute WACC and arrive at 6.96%. Next, Iris will be talking about ESG factors that impact the firm value.
Thanks, Lee. Philips has defined KPIs for its long-term value creation in terms of financial, environmental, and social, which also correspond to its most material ESG factors. Among these, the financial KPI indicates boosting sales by digital innovation, and the environmental KPI indicates driving margins by energy savings and circular economy. These two have been directly translated into value creation and are used to adjust the value drivers in the DCF valuation. Apart from these, Philips also makes positive environmental impact by emission saving, waste recycling, product refurbishment, and etc. Its social impact is positive as in improving treatment success rates, lowering cost base, and improving employee satisfaction and equality. It also makes positive governance impact by reducing the risk of regulatory punishments and data privacy and corruption issues. Apart from all the positive factors, we have also identified one major ESG risk, which is carbon footprints, since Philips reported its environmental impact of 7.2 billion in 2017. However, Philips has emphasized emission savings within its environmental KPI, so we expect that the risks are well managed. When replicating Philips' value estimation, since the sales growth and EBIT margins are identified as directly impacted by ESG factors, we have listed here the percentages excluding and including ESG impact. We can see that including ESG impact, the sales growth is 1% point up and the EBIT margins are 2% point up based on the case analysis. The WACC has been recalculated and is unchanged with or without ESG impact to avoid double counting. According to the DCF valuation, the enterprise value is up by 22%, including ESG impact, and the equity value and the stock price are both up by 24%. The complete DCF calculation spreadsheets can be found in the link. Now I'll pass it on to Michael to elaborate on the uncertainties.
Thanks, Iris. So we wanted to truly understand how ESG initiatives were impacting our equity valuation. To that end, we ran a Monte Carlo simulation consisting of 5,000 iterations. The output of that simulation is listed on the top right of the slide. For the simulation, we modeled the financial metric changes outlined in the case using continuous uniform distributions following the numbers that were provided. We also used distributions for the WACC, the tax rate, the long-term growth rate, the WACC, the tax rate, and the long-term growth rate, for perspective on how sensitive the valuation is to the ESG change predictions. As you can see, using the 5 distributions, 90% of the valuations fell between a valuation of 32 billion and 59 billion euros. For the WACC, we used a normal distribution centered around our calculated value with a standard deviation of 10% of that calculated value. For the tax rate, we used a discrete uniform distribution with 3 values. Given the timing of the case that Lee alluded to earlier, the TCJA is a pertinent piece of tax legislation from that time, and we used the pre-legislation rate, the post-legislation rate, and a median number as a proxy for a reversion to a higher rate. This was done to model the valuation's resiliency to changes in taxation and the event that other countries might follow suit. Finally, we included a triangle distribution for the long-term growth rate centered on the 2% number provided in the case, with a minimum of 0.5% and a maximum of 3.5%. We did this to account for rising volatility and wanted to ensure that our simulated growth rate was not negative. In the bottom right of the slide, you can see the 5 inputs and how sensitive the valuation is to each metric. In summation, while the margin and sales growth effects from ESG are not immaterial, one can see that the equity valuation is largely driven by both the WACC and the tax rate. Next, Abhi will discuss some issues and suggest improvements to the current valuation approach.
Thank you, Michael. We identified 2 main issues with the current valuation approach. The first one is with respect to the discount rate. My colleague Iris had mentioned potential double counting if the discount rate were to be adjusted. One of the key points to note is that the rationale behind not adjusting the discount rate by Philips was due to the fact that they couldn't identify what the business risks and the financial risks were. That would imply that once they figured out what those risks were and the impact it would have on the discount rate, there would be a willingness to change that discount rate. Our approach is to not adjust the discount rate regardless of understanding the business and financial risks of the business. The reason for this is because those changes and those impacts are already taken into account in the forecast of the analysis of the valuation through margins, through sales growth, through various cost items. From a margins perspective, we noticed that the margins were changed instantaneously after the ESG initiatives were taken on. Our thought process and critical thinking on that issue is that those margins need to be scaled. Taking on the ESG initiative and recognizing the benefit of that ESG initiative involves a time lag. We note that both of these issues do have a material impact on the valuation. As we can see, it has an impact from a discount rate perspective from a $34 billion valuation to a $58 billion valuation, and from a margin perspective from a $41 billion valuation to a $46 billion valuation. We can refer to the tornado graph that Michael Cook performed and spoke to on the previous slide. From an alternative approach perspective, we note that there is an opportunity to use a market approach. The company currently used an income approach. An alternative to that would be to find comparable companies that have a similar size, risk, future growth, and financial performance of Philips to learn about what ESG initiatives those companies had taken on and what their financial impact on those companies were, and relate that back to Philips within reasonable context and understanding of Philips operations and the fact that there might be some differences. However, that could be used as a proxy for determining the impact of ESG, along with assessing geography, location, and various other factors. From an improvement standpoint, we noticed that two considerations had not really been taken into account in the valuation approach and discussion. The first one is with respect to interest rates, and the second one is with respect to tax credits from the government. With respect to interest rates have a very significant impact on cash flows and ESG initiatives. We believe that it's really important to recognize that the context of today's macroeconomic environment involves historically low interest rates. As inflation has been a more important topic in current events lately, we believe that there is a risk that interest rates will be increased in the near future. The impact of this is ESG cash flows are typically, and the rewards from taking on those initiatives are typically seen quite a few years in the future. If interest rates are higher, the effect of those cash flows are lower from a present value perspective. If interest rates are lower, those cash flows will be taken more into consideration because it would have a higher impact on the valuation of the business. As a result, we believe that we need to consider the impact of the interest rates as interest rates go up, firms will be less incentivized to take on ESG projects. From a tax credit standpoint, we noticed that the tax rate had remained stable at 25%. Government support programs, however, are available for various companies that have ESG initiatives. And we believe that the tax rate should be changed to reflect these tax credits from the government. This would actually increase the valuation of the company on a ceteris paribus basis compared to what the company already has. Overall, we would like to thank you for taking the time to listen to our presentation, and we look forward to addressing any questions you may have in our lecture. Thank you.